Rising costs have long been a subtle force reshaping societies, often eroding the purchasing power of everyday earners while bolstering those with substantial holdings. In the annals of economic history, this phenomenon, known as inflation, has served as a mechanism for governments and institutions to navigate fiscal challenges, though at a considerable human cost. Families in the early 20th century, for instance, relied on stable currencies backed by tangible assets like gold, which imposed strict limits on monetary expansion. This gold standard era fostered predictability in daily life, where workers could plan budgets without fearing sudden devaluations, but it also constrained responses to crises, leaving leaders with few options beyond austerity measures that deepened public hardships. The rigidity of gold-backed money became painfully evident during the Great Depression of the 1930s. As global trade contracted and unemployment soared, deflation took hold. Prices plummeted, making debts more burdensome for farmers and factory workers alike. A loan taken out for a home or machinery suddenly required repayment in currency that was worth far more, pushing many into bankruptcy and foreclosure. Ordinary people hoarded what little cash they had, fearing further losses, which only worsened the economic stagnation. Policymakers, grappling with widespread despair, evident in breadlines and mass migrations, began questioning the virtues of unyielding monetary discipline. This period of deflationary spiral highlighted how a shrinking money supply could paralyze commerce, amplifying fears among leaders that without intervention, societal collapse might follow. World War II marked a pivotal shift, as nations accumulated unprecedented debts to fund military efforts, often exceeding 200% of their gross domestic product. In the aftermath, rather than imposing harsh tax hikes that could stifle recovery and provoke unrest, governments turned to controlled inflation as a discrete solution. Through the 1950s and 1960s, mild price increases gradually diminished the real burden of these obligations, allowing economies to rebuild without overt sacrifices from the populace. War veterans returning home found their savings somewhat preserved, yet the subtle erosion affected pensioners and fixed-income families, who watched their nest eggs lose value amid rising living expenses. This era taught economic stewards that inflation, when managed, could facilitate growth by encouraging spending over hoarding, though it introduced uncertainties for those dependent on wage labor. A critical turning point arrived in 1971 when U.S. President Richard Nixon, under pressure from mounting trade deficits and gold outflows, suspended the dollar's convertibility to gold. This decision, initially framed as a short-term fix amid fears of economic instability, severed the last ties to commodity-backed currency, ushering in an age of fiat money reliant on public trust and policy discretion. Central banks gained unprecedented flexibility to expand money supplies, but this came with risks. Traders and investors adapted by favoring assets that appreciated with inflation, while everyday households faced the anxiety of unpredictable costs for essentials like food and fuel. The move reflected broader geopolitical tensions, including the costs of the Vietnam War and oil shocks, where leaders balanced national ambitions against the immediate pressures on citizens' livelihoods. In this new framework, inflation emerged not merely as an occasional disruption, but as an integral component of economic strategy. Borrowers, particularly those with fixed-rate debts like mortgages, benefited as the real value of repayments declined over time, enabling ambitious entrepreneurs to scale businesses despite initial financial strains. Conversely, savers, often cautious middle-class families building reserves for education or retirement, endured silent losses, their bank accounts yielding less than the rate of price increases. This dynamic fostered a long-term divide. Asset owners, such as landowners and stock investors, saw their wealth compound through nominal gains, while wage earners struggled to maintain standards of living, leading to widespread frustration and a sense of systemic unfairness. Historical precedents underscore this pattern. In Weimar Germany during the 1920s, hyperinflation devastated the middle class. Clerks and teachers carried wheelbarrows of cash for basic goods, their life savings rendered worthless overnight, fueling social unrest and political extremism. Industrialists with tangible assets, however, consolidated power by acquiring devalued properties, emerging from the chaos with amplified fortunes. Similarly, post-war Britain employed inflation to alleviate its imperial debts, sparing taxpayers immediate pain, but gradually diminishing the value of pensions for war widows and retirees, who felt the quiet betrayal of eroded security. In the United States of the 1970s, stagflation, High inflation, coupled with unemployment, pressured families to cut back on necessities, as oil embargoes and policy missteps amplified fears of endless economic decline, yet commodities traders and real estate holders capitalized on the volatility. The Cantillon effect, observed by 18th century thinker Richard Cantillon, explains much of this inequality. Fresh money injected into the economy first reaches financial elites, banks, corporations, and governments, allowing them to invest before prices rise, thus preserving and enhancing their advantages. By the time it trickles down to laborers and consumers, inflation has already diluted its worth, exacerbating class divides. This principle, rooted in early mercantilist observations, reveals how monetary policy perpetuates hierarchies, with early recipients navigating markets with foresight, while others react to inflated realities, often under duress. Central banks institutionalized this approach in the late 20th century, targeting around 2% annual inflation as a benchmark for stability. This modest rate, presented as a scientific ideal, sustains credit expansion essential for modern economies built on borrowing. Over decades, however, it halves currency value, a fact that dawns slowly on individuals planning long-term futures. Retirees on fixed pensions experience mounting pressures as healthcare and housing costs outpace adjustments, fostering a pervasive uncertainty about financial independence. Governments favor this erosion because it lightens public debt burdens without explicit defaults, enabling investments in infrastructure and social programs that might otherwise provoke taxpayer revolts. The 2008 financial crisis exemplified inflation's role in crisis management. As housing bubbles burst and banks teetered, central banks unleashed quantitative easing, purchasing bonds to inject liquidity primarily into financial sectors. This rescued institutions but inflated asset prices, benefiting portfolio holders while wage stagnation left millions of workers, many facing job losses and home evictions, in prolonged hardship. The policy, driven by fears of a deflationary repeat of the 1930s, underscored leaders' preference for controlled inflation over systemic resets, even as it widened wealth gaps and sowed seeds of public distrust. Echoing this, the 2020 pandemic response involved massive stimulus, channeling funds to households and businesses to avert collapse amid lockdowns and supply disruptions. While this prevented immediate catastrophe, it ignited sharp inflation not seen in decades, straining families with surging costs for groceries and energy. Stock markets and property values boomed for investors, but essential workers and small business owners grappled with uncertainty, fearing long-term debt traps. This episode highlighted how external shocks amplify built-in inequalities, with policymakers navigating the tension between short-term relief and enduring consequences. From a long-term perspective, inflation's necessity stems from the debt-fueled nature of contemporary capitalism, where constant expansion averts stagnation but demands perpetual devaluation. Without it, deflation could trigger widespread defaults, as seen in historical downturns, halting investment and trade. Yet this system imposes real-world tolls. It cultivates a culture of immediacy, where individuals forego saving in favor of consumption or risky ventures, driven by the fear that idle money diminishes. Leaders, too, operate under pressure, weighing ambitious growth targets against the human fallout of inequality, often opting for inflation as the lesser evil to maintain social order. Psychologically, inflation reshapes societal norms, rewarding boldness in borrowing while penalizing prudence, turning economic participation into a high-stakes endeavor. Families pass down lessons of adaptation, shifting from cash reserves to asset accumulation, yet many remain caught in cycles of vulnerability, their ambitions tempered by the relentless grind of rising expenses. This behavioral shift sustains the economy's momentum, but at the expense of widespread security, illustrating how financial mechanisms influence not just markets, but the fabric of daily life. In essence, inflation represents a calculated trade-off in economic history, a tool for solvency and progress that, while averting outright failures, channels prosperity unevenly. It fuels empires and innovations but extracts from those least equipped to counter it, embedding a structural bias toward the resourceful. As societies evolve, the challenge lies in mitigating its harsher effects without dismantling the growth it enables, a delicate balance that continues to define policy debates. For more deep, carefully researched stories from economic history, subscribe to our channel, Einstein of Economy.